This chart is likely the reason that you invest. It's the pursuit of financial gain through the increase in asset prices. But at some point in our investing lifetime, we'll be given a challenge, multiple of them in fact, which will determine whether we're going to make money from investing or not. They come in all different shapes and sizes, but they look a little bit like these. They are amongst the most famous market crashes on record, all of which have had their respective declines of 20% or more. But that's not all. We've also had 2015, 1987, 1973, and even as far back as 1637, and a long list of others. And the truth is, these market crashes occur on average every 3.5 years. So with the last one being back in 2022, then we're actually due one anytime now. So I decided to analyse the last 100 years of stock market crashes to understand what we could learn from the past in order to ensure that we're prepared for the future. And today I'm going to share exactly how not to lose money when the inevitable challenge occurs. What do all three of these charts have in common? The one thing that instantly comes to me is the price acceleration. You can see just how rapidly prices have increased for each respective asset class during each respective time period. In the late 1630s, a Semper August tulip cost upward of $1 million in today's money. In the dot-com boom, companies like Webvan, an online grocery store, was valued at the equivalent of $17 billion today, yet lost money on every order. And finally, we have the recent gold rally, with prices up 200% in 2 years, with investors curious to see whether prices can go much higher. All of these rapid asset price increases point to a similar pattern that we've seen throughout history, and it's triggered by something called overconfidence bias. It's easy to look back now at tulip prices and even the dot-com bubble, and perhaps even some investors are looking at the current price of gold and thinking how stupid investors are. But the reality is, right the way back in the day along with right now, our brains function exactly the same. And whether it's the contract notes back in the 1600s or our brokerage accounts today, seeing the monetary value of those accounts going up and up is what makes us feel a greater sense of skill or ability over everybody else. But that can also lead to our biggest downfall. In 1990, two researchers called Richard Thaler and Eric Johnson published this research paper called The House Money Effect, and it explains why. The paper describes experiments that show a common pattern, that when investors are up, they act like the gains aren't theirs. It's the house's money, so to speak, so they take the risks that they wouldn't have otherwise done with their hard-earned pay packet. Let me test this on you to see whether it rings true or not. Imagine that you're at the casino and your numbers have just come up on roulette and you've won £500, and the dealer then gives you two options. Option A is that you walk away and keep the 500 quid, or B, you gamble with a 50% chance to gain another 250 quid, or a 50% chance to lose 250 quid. Which are you going to choose? Logically, the risk-averse person would probably choose option A, and just being honest, that's the option that I would probably choose. However, because of the house money effect, you're essentially gambling with the casino's money that you didn't have before. So that prior win of £500 makes losing £250 less painful, and because of that, most people will choose to gamble. And that's possibly why one of the reasons that people back in the 1600s would gamble their house on tulip contracts, and perhaps why in 2026 gold and silver ETCs jumped up in the trading 2-on-2 most popular ETFs list compared to just 12 months prior. This is how overconfidence bias mixed with a little bit of FOMO turns a healthy bull market into a bubble that eventually bursts.
The signs were everywhere, but now it's official, we are in a recession.
Just broad-based declines across all of the major technology sectors. Apple's under pressure.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black.
So how do you stop the house money effect from absolutely clearing you out? Well, investors need to stop playing the game of emotions and instead consider systematic rebalancing. Ironically, it's what I replied to an Instagram comment, I don't know, maybe a week or so ago when gold was priced at all-time highs. Be sure to follow me whilst you're over there if you don't already, but let me share with you an example of how it works. Imagine you have a £10,000 investment portfolio, your strategy is 90% in global stocks and 10% in gold. Suddenly the market goes a little bit mental and your global stock portfolio is up 20%, and your gold investments went up by 72%. And yes, these are actually the real rates of return just over the past 12 months. Now, some investors would see the gold rally and think, well, I must buy more of that asset class because it's the best performing one. But that's the house money effect taking place, and actually smart investors do the exact opposite. Now, instead, they now sell that extra 4% allocation that they had to gold, and they redistribute those funds to their global stock portfolio. They're effectively being forced to buy low and sell high, whilst retaining their strategic asset allocation, which they chose before emotions came into play. It takes me back to that famous quote from Warren Buffett, who once said, "Be greedy when others are fearful, and fearful when others are greedy." And systematic rebalancing is the mechanical way to follow that advice without letting your brain get in the way. Quick side note as well, guys, I've just launched a brand new newsletter where I provide all kinds of market insight, along with some financial education, which you can sign up to completely for free by clicking on the QR code here, or be sure to click on the link down in the description below. That being said, let's get back to the video. I started investing in 2017 with just £400, and today my investment portfolio sits in the multi-six figures. And during that period of time, I've experienced 2 bear markets of 20% or more, and 4 market corrections greater than 10%. And trust me, I remember that first market correction like it was yesterday, when I saw a full 12 months worth of gains in my investment portfolio absolutely evaporated within quick succession, seeing my portfolio sitting in the red for the very first time. But how I reacted to that first market correction, and every market correction and crash that I've seen and experienced since then, is what I believe is one of the fundamental reasons why my investment portfolio is firmly sat in the green today. But before I explain what I've done historically, first let me address the point that some investors would do the exact opposite when shit hits the fan, and as a result they become their own worst enemy. I've always wondered, why do investors sell at the worst time? And the answer is actually quite simple. It's because of something called loss aversion. In a classic 1979 study, it was discovered that the aggravation that one experiences in losing a sum of money appears to be greater than the pleasure associated with gaining the same amount. Now, when the market crashes, I think this theory becomes more heavily weighted, because we're not just talking about the potential unrealized loss of, say, £1,000, which, don't get me wrong, is still a decent amount of money, but we're more talking about some people who have built up stocks ISAs and pension funds over many decades, and their unrealized losses could sit in the tens of thousands of pounds. So I certainly have empathy with people that are in that position, whereby they're staring down the barrel of huge unrealized losses and thinking, well, do I sell now to prevent myself from losing more? But for those with a long enough time horizon ahead, research shows that investors who panic sell during periods of high market volatility massively underperform those that just stay the course. Why? Well, because almost always they miss the recovery. If you sell to stop the pain, you have to be right twice. You have to exit at the right time, but you also have to re-enter at the right time. And timing the stock market is a little bit like predicting the British weather in 6 months from now. It could be absolutely pissing it down with rain, or it could be a gloriously sunny day of 25 degrees. But here's the difference. If you get the weather wrong, then you just get wet. But if you get market timing wrong, you don't just get wet, you potentially drown your future self's retirement plans, and nobody wants that. Research shows from JP Morgan, if you miss just the best 10 trading days within the market over a 20-year period, your total returns would be cut in half. But guess when those best days are likely to happen? Yep, right in the middle of the bear market, 78% of the time. So how do investors avoid the herd mentality of being a sheep and selling when the going gets tough? Well, time horizon has a big part to play in this. If your time horizon is 10, 20 or 30 years, then what could be one of the scariest times in your investing lifetime, looking at your investment portfolio, could just actually be one of the best buying opportunities that you'll ever have. Remember the bit of the Warren Buffett quote which goes, "Be greedy when others are fearful"? Well, that's exactly what I'm referring to right now. And look, just to show you I practice what I preach, here are all of the market crashes and corrections that I've experienced and exactly what I did on each occasion. Instead of selling, I bought, and I bought in volumes that I could afford, but also looked to invest heavily when I could too. And look, whilst of course I obviously can't predict the future, as long as capitalism and inflation continues to be a thing, then asset prices in 30 or 40 years from now, when I'm looking to retire, should be higher than the prices that they are today, and therefore any investments that I'm making today should hopefully be productive ones. As I've experienced before, staying the course is easier said than done when you're looking at your portfolio deep in the red and a news cycle that is predicting the worst case scenario. If researching history over the past 100 years has taught me anything, it's not that you need to be the smartest investor, and instead it's more about building the right structural defenses. which is why I've personally built up my own fortress portfolio. And there are 3 pillars to it. Pillar 1 is the survival fund. One of the reasons that people decide to sell during a market crash isn't totally because they're scared of losing money, it's because they have no other option. If a market crash coincides with losing a job or an unexpected bill, investors can be forced to sell. I've only experienced 2 market crashes in my investing lifetime, but I feel like I've won because I had enough cash on the sidelines to cover a 12-month emergency fund. This cash isn't dead money, it's my physical shield or security blanket that protects my investments from my own desperation. The second pillar is asset exposure. We talked about systematic rebalancing earlier, but as I mostly invest in global ETFs, that rebalancing kind of takes place automatically, because throughout history, different countries and different sectors have been stronger at different points. Back in the early 1900s, it was the railroad locomotive, followed by industrials, followed by banking, and then into tech. But throughout that period of time, different countries had their strengths too. And whilst this is a chart of the S&P 500, simply because it's the only one with a long enough history I can present, you'd probably be interested to know that one minute the UK and US markets were trading places for periods of growth, followed by Japan, and then back to the US again in most recent times. A fortress portfolio doesn't try and select the winner, and instead I accept that parts of my portfolio will underperform today, but then that same part will be my portfolio's saviour tomorrow, especially when a capital rotation takes place. Pillar 3 is the automation offense. Remember that JP Morgan study that I showed you about missing the best 10 days? The only way to ensure that you're in the market for those best days is to simply take your hands off the steering wheel by setting up either a direct debit or an auto invest feature to ensure that you turn some of those scary days into hopefully profitable long-term days ahead. Because when the market drops 30%, then your same fixed investment each month will buy 30% more shares. You just might have to turn off the news for a few months. Looking back at a century of data, market crashes are part of a normal and healthy financial system. What makes them more challenging is a mixture of human psychology and investment strategy. But for those who have understood the house money effect and have resisted the urge to follow the herd, and have also built themselves a financial fortress of a portfolio, then any market crash is simply a case of transferring wealth from the impatient to the prepared. The next crash is coming. It might be another 3 months or it could be another 3 years. But when it arrives, I hope you remember this video and exactly how not to lose your money.